Mwalimu, I have a question before you start on the company accounts.
Yes.
I watched the Thursday class video and
Company accounts. We have so far talked about the financial statements of a sole trader, the financial statements of the company, and now we are doing the financial statements of a company, which is actually the most complex form of business organization in terms of the ownership. The owners of the business are so many when it comes to a company. For the partnership, the maximum is 20, around there. For the sole trader, the owner is only one. In company, especially the public companies, we don't have the specified maximum number of partners or shareholders. So in the company accounts, you realize that we are going to have so many owners who we call the shareholders. The shareholders are simply those people who have bought shares in that particular company. The moment you buy shares in a company, you become a shareholder of that particular company. But you need also to understand that when it comes to company accounts, we have got two types of companies. We have those companies we call public, and we have got those we call private. Public companies are those companies that invite the members of the public to buy their shares. Their shares are easily transferable from one shareholder to the other. So if, for example, I want to buy those shares, I can freely buy them. If I wish to sell them, I can sell them. So those companies whose shares are freely transferable, we normally call those companies public companies. And in Kenya, all those companies whose shares are traded in the Nairobi Stock Exchange, they are said to be public companies. They are said to be public companies. Any company whose shares is trading in the Nairobi Stock Exchange, we normally refer to that company as a public company. Anybody can buy the shares in that company. Anybody, or if you wish to dispose your investment in that company, you can. They are known as the public companies. So those companies which are listed in the Nairobi Stock Exchange, they are all public companies. For the private companies, these are companies that are either formed on the basis of friendship or at family level. So those companies that are owned by family members or by a group of friends, and they don't invite members of the public to join them, we normally call them the private companies. So these are companies, yes, but they don't invite members of the public to subscribe for their shares. The other thing that you need to note when it comes to company accounts is that their main source of capital is what we call the share capital. Source of capital. Their main source is actually what we call the share capital. The share capital, it is capital that is going to be raised when the company sells the shares. When the company sells the shares to the public, it raises money. The money it raises from the sale of shares, we normally refer to it as the share capital. This share capital is of two categories. We are going to have what we call the ordinary share capital. The ordinary share capital, it is the capital that has been raised through selling of ordinary shares. Ordinary shares are those shares that carry with them what we call the ownership rights. If you buy ordinary shares in a particular company, you become among the owners of that particular company, and therefore you are supposed to be involved in the decision-making of that company. When it comes to annual general meeting, you are supposed to be invited if you are an ordinary shareholder. So ordinary shares are those shares that carry ownership rights in a company. The members who buy the ordinary shares, they will have what we call the voting rights. In the companies, one share is equivalent to one vote. So if you happen to be the majority shareholder in a company, it is going to mean that you are the one who is going to make the decision on behalf of the entire company. If you have 50% and above of the ownership, then you are going to be making decisions for that particular company, because anytime a particular matter is subjected to voting and you vote in favor of a particular decision, Even if all the others, they vote against that, because you are the majority shareholder, your actually vote will carry the day. That's why you find that companies like the KPLC, it is like they are owned by the government, because the government is the majority shareholder. When it comes to appointment of directors and all that, the government will always do that, because even if we have got other members of the public who are shareholders in that company, the sum of the shares they hold in that company is less than 50%, which the government is owning. So the government has more shares than all the others cumulatively. So it is going to be making a decision on behalf of the other shareholders. So in a company, one share is equivalent to one vote. The more shares you have, the more votes you have. If you have got more than 50% of the shares in that company, then it simply means that you will be actually making all the crucial decisions in that particular company. So the ordinary share. When the company sells the ordinary shares, those who buy those shares, they become owners of the company. Then we have got other category of shares, which we call the preference shares. We have what we call the preference share capital. The preference share capital, it is capital that is raised when the company sells the preference shares. The other category of shares is what we call the preference. These shares are preferred. They are preferred when it comes to payment of dividends. Remember, the preference shares, they don't carry voting rights. And those who buy these shares, they are creditors to the company. They have given money to the company, but they are not owners of the company. Because of that, when it comes to declaration of dividends, the preference shares holders will be given dividends before the ordinary. They are actually preferred. They get preferential treatment when it comes to distribution of dividends. They are actually to be given the dividends first, and then if there is anything that remains, that is what will go to the ordinary shareholders. So they are given preferential treatment. And the reason being, these people is like they have lent money to the company, they are not the owners, and actually these shares, they normally carry a fixed rate of dividends. So you'll find that you are going to get in the question, like for example, you'll be told it is 12% preference shares, meaning that these preference shares, they will be attracting dividends of 12% of what that person invested in the business. If I invest 100 million for buying the preference shares, then I would be getting dividends of 12% of 100 millions every year. So they get some preferential treatment. After understanding that companies we have public and private, their main source of capital is through the issue of shares, either the ordinary shares or the preference shares. You also need to understand that companies, they have a particular loan which they can sell to the members of public, which we normally call the debenture. Debenture is a secured loan whereby you can raise money from the members of the public. Each and every year, those members will be paid interest. They will be paid interest. Then on maturity, you can buy a debenture maybe of 10 years. You will be earning interest for 10 years. Then at the end of the 10th year, you will be given your principal amount back. That is to say, if I buy debentures worth $1 million, this will come with an interest percentage, maybe it is 10% debenture. I will be earning interest of 10% of 1 million every year. Then at the end of the debenture period, I will be given back my 1 million, and then that is the end of it. So it is a special loan that is secured, that is normally issued to the members of public, actually through the Nairobi Stock Exchange. Those who subscribe to that debenture, they will be earning interest on annual basis, and then on maturity, they are paid back the principal amount that they invested there. So you will find this one. This is a long-term liability. Long-term liability, and it is going to be attracting debenture interest. Debenture interest, we shall be taking, we shall be considering it as an expense. Debenture interest is an expense, but the debenture amount itself, it is a long-term liability. Then from there, you also need to understand that in a company, when we go to the statement of financial position, we have said that under the capital, which we shall be referring to it as the equity, under the equity, we shall be talking about the share capital. And the share capital here is either the ordinary share capital or the preference share capital. Then we shall be talking also about what we call the reserves. Reserves, this is money that is set aside for a particular function in future in the company. And under the reserves, we have what we call the share premium. The share premium reserve. The share premium reserve, it occurs when the company sells shares above the par value. The par value, it is actually the value of one share that is going to be contained in the share certificate. When you buy shares in a company, you will be issued with a share certificate to actually act as an evidence that you own shares in that company. The price that is going to be contained in that particular share certificate, we normally call it the par value of each share. But you'll find that most companies don't sell their shares. Yes?
Just start again on the reserves, sorry, on the share premium.
The share premium, that is what I'm talking about. This is actually an amount of money the company will realize when it sells its shares above the par value. When you sell shares above the par value, the par value is the value that is going to be contained in the share certificate. When you buy shares, you will be given a share certificate. The share certificate will contain the price of each share. That price of each share that is captured in the share certificate, we call it the par value. But you realize that the par value that is indicated in the share certificate might not be the price at which you bought the shares. You can buy the shares at a slightly higher price than the par value, especially when the company's shares are so marketable and they are in demand, they can sell their shares slightly above the par value. So if we say the par value of one share is 10 shillings, if the par value is 10 shillings, but we manage to sell our shares at 12 shillings each, then the 2 shillings on top is known as the share premium. Is known as the share premium. So the share premium reserve will actually be the 2 shillings that is extra times the number of shares the company has sold, because each share has got 2 shillings extra. So the 2 shillings extra, if the company has sold 100,000 shares and each share is attracting a share premium of 2 shillings, 200,000 will be our share premium reserve. Somebody has asked here, meaning share premium is my interest, and no, it is not interest from your end. It is now it is actually going to be an income from the company's end. Remember, the company has sold shares to you at 12 shillings instead of 10. So you are paying 12 shillings to buy the share instead of 10 shillings. So you have paid 2 shillings extra. That one becomes an income to the company. So the company will actually have received 2 shillings times the number of shares. That is what we call the share premium reserve. And actually it is part of the equity of the company. Thank you. Then we also have another reserve. We normally refer to this as the general. The general reserve. The general reserve. This occurs where the company normally deposits a certain amount of money each and every financial year. Every end of financial year, we deposit or we save a certain amount of money for a particular purpose in future. Maybe as a company, we want to open a new branch in a new town. So we say that we have like a 10-year plan for that. So each and every financial year in these 10 years, we shall be saving, like, for example, 2 million. So every year, we shall be transferring a certain amount of money from the profit to the general reserve so that it can accumulate. By the end of the 10th year, we shall have actually accumulated enough money to actually undertake that particular project the company wants to undertake. So it is like a saving plan. Each and every year we do a saving. So it is something that is going to be cumulative. And then we have got the retained earnings. Retained earnings. This is undistributed profit, also known as the general, not the general, but revenue. It is known as the revenue reserve. This is profit that is not distributed at the end of the year. After we have paid the shareholders their dividends, we have transferred some money to the general reserve, and then we remain with something. Whatever remains now, it is what we call the retained earnings, which is actually also known as the revenue reserve. And then we also have what we call revaluation reserve. Revaluation reserve. This is actually a reserve that is going to happen when we revalue our assets. That is to say, the fixed assets, especially land and buildings. When we do some revaluation, or they have a tendency of appreciating land and buildings. So you buy land, after 5 years, the value has gone up. The difference between the acquisition cost and the new value of that particular property after a certain number of years, that increase is known as the revaluation reserve. All of these are going to be added to share capital. We normally consider them as equity. So we shall have the share capital, we shall have the reserves. All of them, we shall combine them and refer to them as equity. Equity. What else do you need to know about the companies? We have other extra expenses. Apart from the expenses we know, we have got now the debenture interest, which we are going to consider it as an expense. The director's remuneration, it is going to be an expense to the company. The auditing fee is another expense that we are going to witness when we come company accounts. Having done that kind of introduction, allow me now to take you to the financial statements of a company. Financial statements of a company. The financial statements of a company, very similar to the sole trader or partnership, with some few adjustments here and there. Number one, we are going to have the appropriation. Appropriation account. The appropriation account. Appropriation is simply an account to show how income or profit was shared. Part of the net profit that the company is going to generate will go to paying the dividends. After paying the dividends, actually not the dividend first, we normally pay tax first. Companies normally pay corporation tax. After paying the corporation tax, what remains, it is shared or distributed to the shareholders as dividends. Part of it also will be transferred to the general reserve, as we have said. Then if there is anything that has remained, it is going to be carried forward to the next year as a retained earning or revenue reserve. But the appropriation account will have the following format. Net profit, we call it profit before tax. We call it in company the net profit. Here we shall refer to it as a profit before tax. Profit before tax, put it there. Then you less the corporation tax. You will be guided on how to get that figure, or you will be given that figure so that you can get a figure there, which we shall refer to it as a profit after tax. After getting the profit after tax, there is that retained earnings for the previous year. Remember, we said retained earnings is the profit that is not distributed. That profit that was never distributed the previous year, we normally come and add it here to the profit after tax for this year. So you add retained earnings, or remember it can also be known as the revenue reserve. Revenue reserve carried or brought down. You add it so that you can get a figure there. That figure that you get after adding the retained earnings for the previous year, we use that amount now to pay, less here now, the payment for dividends. The dividends here, they are the ordinary dividends, and we have the preference dividends. At the same time, the company can decide to pay dividends in the middle of the year, and then they pay the balance at the end of the year. The dividends that are paid in the middle of the year are known as interim dividends. Interim dividends are those dividends that are paid in the mid-year or somewhere within the year, but before the year ends. And we can have interim ordinary dividends, what we have paid, and then we also have interim preference dividends, what we paid them. We shall get a figure there. We add to that final dividends, final ordinary dividends. Also, we have the final preference dividends. We get a figure there. Then lastly, you less transfer to general reserve. Then you will get now retained earnings carried down. Any undistributed profit after doing all those deductions, it is the retained earnings carried down. And this figure is the figure that we shall use as part of the equity in the statement of financial position.
Mwalimu, you're going too fast. I'm struggling to catch up.
Are you writing?
Yes, you are.
Yeah.
Okay. Write fast for those who are writing.
So just Mwalimu, just before I continue, just a question there. So the interim ordinary shares and the interim preference, you add those ones, and then the next one is?
No, these are dividends. Huh? We are under the interim ordinary dividends. The interim dividends. Huh? We add them, we get this figure. This one is the final ordinary dividends and the final preference dividends. You add them also to get this figure. Yeah? And then you rest now. This figure that we had, you minus this, and you minus this to get this.
Less transfer to general reserve. Okay.
Yes. The money that from that profit, there is a certain amount of money that we have transferred to the general reserve so that it can keep on accumulating.
Okay, I understand.
Yes. Having done so, now I think we can do example 1. That past paper question that we go to our WhatsApp. There is a document that I shared about the company accounts that has these questions. I shared, was it on Friday or Thursday? It is written the company accounts. You got it?
Yes.
Maybe some of you don't have it. Let me resend. I've just resent the document. The company accounts discussion quiz. The first question there. The following data relates to Taita Taveta 1971 Traders Limited for the year ended that 1st December 2016. So we are given the figures, and then at the bottom there we are required to construct the appropriation of profit and loss account as at 31st December 2016. And then we are told arrange items in order of priority. So if everybody has the document, we can now go to the board. So if we have that question and we are told to prepare the profit and loss appropriation account, we can comfortably do it. So this is Taita Taveta 1971 Limited. That will be referred to as profit and loss appropriation account for the year ended 31st December 2016. So the profit for the year, net profit for the year 2016, hope you can locate it, is item number 1, 2, 3, 4, 5. Now item number 5 from the top. Profit for the year 2016, that is our profit before tax. Amounting to 859,600. The first thing we normally do after the company has earned the profit is to less tax. So we pay the tax. The corporation.
So this one has, just to clarify, this one only has 2 columns. It's not like the other one, the partnership account where we had put 3 columns.
So this one is simple. Remember, for 3 columns, we said the 3rd column is for purchases. Here we shall not have purchases.
Oh, okay. So only 2. Okay.
Only 2 are enough for the appropriation part.
Mwalimu, what about the profit for 2015? We brought forward.
That is now the revenue reserve for the previous year. We shall add to the figure we shall get after deducting tax. The revenue reserve brought forward, because that is for the previous year. Corporation tax. The corporation tax there is, we are told, it is actually the first item. Corporation tax for year 2016 is 214,600 to 14,900. So let us do that computation. $859, 600. You less 214, 900. I'm getting 644,700. Just a minute. That one you should say it is the profit after tax. This one. Then now you come here and add retained. Retained earnings brought down. That is now the profit for the year 2015.
Mwalimu, so that would be the 189 to 10.
Yes, you add that. Just a minute, I transact something here. Yes. The profit for the year 2015, 189 to 10. So what do you get after adding that? Plus 189 to 10. Getting 833, 910. Then from that figure now, we pay anything that we are supposed to pay or transfer to any account that we are supposed to transfer. So we shall come here and do less. What are we given? Dividends first. Dividends comes first before general reserve. We are told here there is final dividends payable to ordinary shares, dividends payable to preference shares, interim dividends paid to ordinary shareholders. So for the preference, we don't have interim. So we shall less the dividends. Here we have the interim, ordinary dividends. Interim ordinary dividends, they are 151,500. Then we have the final ordinary. The final ordinary is how much? 167,400. Then we have the final preference. 68,140. This one, remember, we are resting. Can we do the summation of these two? 167,400 plus 68,140 get to that 540. The last thing, did we transfer anything to general reserve? Yes, the last item, transfer to general reserves.
Mwalimu, I have a question. Huh?
Yes.
I'm looking at it this way. What if we add interim ordinary, the 151,500, then final ordinary, 167,400, then final preference, 68,140, then we less the total what we have gotten from the addition of the all dividends.
Come again, kindly.
I'm saying,
Yes.
what if I add the dividends, the interim ordinary, final ordinary, and final preference? I add,
Yes.
then I come and subtract the total that I've gotten from the dividends. Is that correct?
To deduct the totals from the dividends. Why are you deducting?
Because you have said, because you have said less dividends.
Yes, we are less.
That is all the dividends.
Yes. Or you add all of them. You add all the dividends, huh? No problem.
Yes.
No problem.
Okay.
No problem. There is no problem with that. Huh? If you come here, you add here, this one, if you want to come to this column, then this one, and then you take the total there. Huh?
Yes.
No problem. No problem. Nobody will penalize for that. Huh? Nobody will penalize you for that. Okay. We also less the transfer to general reserve. It is a single figure. This one goes here direct. 308, 120. So the figure we shall get down here, it is going to be retained earnings carried down. So we do the computation. Sorry, I have some reflection here. I'll adjust my mood. So what can we do? We take this figure, we raise all these three. 833 by 10 minus 151, 500 minus 235 by 40 minus 308, 120, getting 138, 750. That's my retained earnings carried down. So when we go to the next year, this figure is the one that is going to appear here. It is going to be added to the profit after tax for the next year. So it goes like that. Then we get the new retained earnings carried down for that next year, which would be forwarded to the other year. How do you determine order of priority? The order of priority is as given in actually the format that I gave you before this question. Profit after tax, the first thing, the first item of priority is to pay tax. After you have paid tax, you pay dividends. After you have paid dividends, you transfer to general reserve. And then if there is anything that remains, well and good. Well and good. But the order of priority, tax first. If you don't pay tax, you will not have peace with the government. Number two, the shareholders will not be comfortable when you have transferred everything to general reserve and you have not paid them anything. You pay them their dividends first, and then you transfer to general reserve. And then if there is anything remains, that one now it is the revenue reserve, which we carry forward. So the order of priority, you just use this order. Tax first, then dividends, then to general reserve. If there is anything that remains, that is our revenue reserve or retained earnings. So that is it.
A question.
Yes.
Just for clarification, what's the difference between the interim ordinary shares and final ordinary shares?
Okay, it is not the interim ordinary shares or interim preference shares.
Sorry,
It is the interim dividends.
Yes,
So
yes, dividends. Sorry.
The interim dividends are those dividends that you pay your shareholders before the year ends. Remember, ordinarily, the dividends are supposed to be paid after the end of the year, after we have declared profit. But most companies, they can give their shareholders some dividends, and then they are going to clear those dividends at the end of the year. So those dividends that comes in the middle of the year are the ones that we call interim. And then at the end of the year, we now do the final dividends.
Final.
Yes, yes.
Okay, thank you.
So, Mwalimu, we can call it like an advance.
Yes, it is like an advance dividend. And then the company will do a top up at the end of the year.
Okay.
Yes. So that is all about the appropriation. So from there, I want us now to do a full question. That is question number 2. We do the income statement, we appropriate, and then we proceed to the statement of financial position. The question number 2. Somebody is requesting I share the recording. This one I must share. The other one I told those who joined the class as I was starting. The video that I did on Friday, I don't know why it refused to convert. So I did not upload it. But whatever I'm doing here, it is exactly the same thing that I did on Friday. So we do question number 2. This here for the sake of recording. Whereby you are told that the following trial balance was extracted from the books of Kamwea Limited as at 30th September 2010. So the trial balance is as given there. And then there is additional information on the other page. And the required part is that we prepare the statement of profit or loss for the year ended 30th September 2020 and the statement of financial position as at the same date. So we all know anytime we are given the trial balance and then the additional information, our focus should first be on the additional information so that as we embark on preparing the statements, we don't omit anything. We make sure that every information has been taken care of. So allow me then to stop the share, and then we do the workings. We do the workings here. We do the workings there. So I hope this one will not help us. I'm just going by the additional information. Number one, it is talking about the stock or inventory as at 30th September. You look at that date, 30th September, and then you compare with the date that we are given on the statements that we are preparing. At the bottom there, the required profit and loss for the year ended 30th September. And here we are given inventory 30th September. So that is the closing inventory. That is the closing inventory. It equals to 31,700. Why use that 1,700 and not that 1,700,000? Because the trial balance at the top there, 3 zeros are also omitted. 3 zeros are also omitted. So we use that 1,300 so that the figures can be actually uniform. Number two, half year interest on 10% debenture. Half year.
Where is the Mwalimu, where is that 1,700 coming from?
Additional information number one. What is the figure you have?
Oh, okay. Let me move to page 2, thanks.
We omit the 3 zeros. Okay. Number two, half year interest on 10% debenture was outstanding. Remember, we said the debenture is a long-term loan. That long-term loan attracts interest. That interest, we normally take it as a business expense. And therefore, we need to know how much debenture interest was payable. So, addition number 2 requires us to determine the debenture interest. It is supposed to be 10% of the value of debenture. It is 10% debenture, so the interest is 10% of the value of debenture. Go to your trial balance and locate where we have got 10% debenture. If you are there, you can be able to see the 10% debenture is 12,000. So we do 10% of 12,000. This one will give us 1,200. The debenture interest should be 1,200. You take just 10% of the amount of debenture that was raised. Still on the trial balance, you go down.
Just a clarification. So if it's indicated there that is a half-year interest, and you're doing it for the year, aren't you supposed to double it or not?
Okay. I will beg to angalia hiyo. Let us look at the debenture interest and then I connect. I know you will understand what I mean. Can you go down to the trial balance and look at the debenture interest paid? Can you locate the debenture interest paid?
I can see there it's 6, is it? Debenture interest paid 600.
Yes. But for the whole year, it was supposed to be
1,200. Oh, okay, I got it.
So they paid only half. They
Half of
only
it.
paid half. So there is outstanding. There is an amount that is not yet paid. Outstanding debenture interest. It is simply 1,200 minus 600. The outstanding amount is what? 600. This 600 has not been paid. We shall take it as a current liability because it is a figure or an amount that by the end of the year we have not paid. So from the business point of view, we have a liability. That is number 2. Number 3, the following information relates to the company as at 30th September 2020. 1, accrued or accruals for business rates. Remember, accrued is an amount that has not been paid, but it is for that year. So we need to do an adjustment on business rates. The business rates that we are given in the trial balance, it is 1, 2, 3, 4. 1, 2, 3, 4. 1,500. We paid 1,500, but 200 is outstanding, so we are supposed to pay 1,700. The accrued amount you always add to the expense or revenue. Add to the expense or revenue, like that. Then, still under additional information 3, we have also.
And what is business rates? Sorry, Mwalimu, we have many questions. What is business rates?
Business rates needs pesa tunalipa kanjo, ama county government. When you have a business, you have to pay those rates.
Okay.
Yes, yes. Then we have got the office expenses. The office expenses amounting to 900. But how much is accrued? We paid 900, yes, but we have not paid 25. So we added the 25. So the amount that was payable was 925. We are supposed to pay 925, and that is what we shall consider as office expenses. Number 4, it is all about depreciation on the non-current asset. And here, anytime you are calculating depreciation, look at the method or the basis. Here, the asset is land and buildings. The rate is 5%. The method, straight line. The method is straight line. When it is straight line, multiply the rate times the cost. When it is straight line, multiply the rate times the cost. So here, for motor vehicle, sorry, not motor vehicle, but land and buildings, its depreciation will be 5% times the cost of land and buildings. So can you go up to the trial balance and locate where we have land and buildings at cost? Land and buildings at cost, it is somewhere there, 80,000. If you do 5% of 80,000, you will get 0.05. 0.05 times 80,000. 4,000. So the depreciation for land and buildings this year is 4,000. Straight line, it is times cost. But reducing balance, tungefanya nini? Who can try? If it was written there, land and buildings 5%, the method is reducing balance. How could we have?
Try, Mwalimu.
Yes, try.
We deduct 8,000, the depreciation for the previous year from the cost, which is 80,000, so it becomes 72,000, and that is what we will have used to do the depreciation with.
Yes, yeah? 72,000 times 5%. You are very correct. So that is very good. When it is net book value or reducing balance method, the depreciation that is given on the trial balance, like in this case, we are told land and buildings at cost 80,000. Below that, accumulated depreciation as at 1st October, 80,000. We deduct that 80,000 from 80,000 to get 72,000. And that 72 is the net book value. That is now the amount we multiply by the rate, which is 5%. Very important for you to go to that. The next asset here is the equipment. The rate is what? 15%. On what basis? Straight line. So we multiply by the cost of the equipment. The cost of the equipment is 32,000. If it is straight line, it is the cost straight and nothing else. Times 32,000. This one gives us what? 0.15 times 32,000. We get 4,800. That is the depreciation for equipment for this year and for land and buildings for this year. Remember what we have calculated here? It is for this year only. What we are provided in the trial balance, it is for the previous years. In our income statement, we normally use these ones because they are for this year only. And in the income statement, we only consider expenses and revenues for this year only. We are not interested for the previous years. Higher. That is said and done. Number 5, it is about the director's proposals. Those proposals are the ones now we use in the appropriation section. Appropriation section, we use the director's proposals. What have they proposed? Number 1, ordinary shareholders to be paid 5 shillings per share. That is the dividends. 5 shillings per share after transferring 1 million to general reserve. In simple terms, if we can simplify that statement, each share of ordinary, we pay a dividend of 5 shillings. So how much dividends are we going to pay to ordinary shareholders? It is 5 shillings times the number of shares that we sold to them. That one we are going to do short. The other thing is that we take 1 million from their profit, we transfer to the general reserve. That is that. And then number 6, the tax charged for the year amounted to 10 million. This was outstanding at the end of the year. So I want to actually do the computation for that. Dividends. How will we know the number of shares? Because it is 5 shillings per share. So the total dividends, 5 shillings times the number of shares. Number of shares is going to be equal to total amount divided by the price per share. The total amount divided by the price per share. That is how we shall know the number of shares. In this case, the total amount, look at it from the trial balance, ordinary shares of 100 shillings each. Ordinary shares of 100 shillings each. And the total amount that we raised is 70,000. So how much? Remember 70,000, 3 zeros are omitted. In the real sense, that is 70 million. If we include the 3 zeros that are omitted there. So here we shall have 70 millions. We divide by price per share. We are told ordinary shares of 100 shillings each. So each share was being sold. So how many shares were sold? These ones, that is going to be 700,000. 700,000 shares. So dividends will be equal to 5 shillings per share, 4 times 700,000. So 5 times 700,000. 3.5. But in our statement, we shall use 3,500. You omit the 3 zeros. That is all. As far as the adjustments are concerned.
Malim, just move it so that we can see the bottom of the screen of the board. Yeah, there. No.
You can't?
A bit more. No. Yeah, there. There.
So that is was a bit, it required some critical thinking. How do you get the number of shares so that you can multiply by the dividend per share? So the number of shares, take the total amount that we raised from the sale of those shares, we divide by the price of each, we shall get we shall get the number of shares. Each share attracts a dividend of 5, so the total dividends is 3.5. You are done with the copying? I can now move.
Yes. Yes.
Okay. We now do the income statement. This is known as Kamwea Limited. Kamwea Limited. Income statement. Yes. As at, not as at, for the year ended. That year, September 20 what? 2020. As usual, now here we need to find out, do we need 3 columns for amount or 2 columns for amount? We said the guiding principle is, does purchases require adjustment? We have carriage inwards, which should be added to purchases, or do we have return outwards, which should be deducted from purchases? Do we have any if we run through the trial balance?
Yes.
We have carriage.
Carriage inwards.
Okay, then if we have it, we shall require 3 shillings. Shillings. It is good to indicate that they are in thousands. These figures of ours are in thousands. We start with the sales. The sales in this business was amounting to 161,600. 161,600. Do we have sales returns? If we run through the business, do we have it somewhere? Sales returns or return inwards?
No.
If it was there, we could have deducted. If it is not there, those sales now becomes our net sales. Then we less, from the sales, we less cost of sales. The cost of sales, you should have it at the back of your mind. Opening inventory, you add purchases, you minus closing inventory. But purchases will be adjusted in this case first. So opening inventory. This is normally found in the trial balance. Somewhere, I think the 4th item from the top, inventory into bracket 1st October 2019. That is the opening period or opening date. 29,000. It is placed at the middle column. Come here and tell me, add purchases. Add purchases. But these purchases of ours will be adjusted first. These purchases of ours will be adjusted first. So we indicate the figure here. First of all, purchases is 82,100. You add to it carriage in. Carriage in. The carriage in, it is amounting to how much? 300. Carriage in is 300. So if we add 300 to purchases, then our net purchases will be 82,400. That is now what we add to the opening stock. Purchases or opening stock plus purchases. But purchases, first of all, you deal with it. You adjust the figure. You bring now here the adjusted figure. So what do we get as the cost of goods available? Cost of goods available for sale. Cost of goods available, it is going to be 29,000. You add 82,400. You get 111,400. 111,400. Then you less closing. Yes. Somebody is saying something? Okay. Closing inventory. Closing inventory, it is in the additional information, number 1, there, that 1,700 less, so that we can arrive at the cost of sales. That one will take us to the cost of sales. So you minus 31,700, we'll get 79,700. 79,700 is our cost of sales. Put it to be in line with the sales, so that now we can arrive at the gross profit. Sales that we got from the goods that we sold. Remember, the goods that we sold, they had costed this much, 79,700. We acquired them at 79,700, but the same goods that we acquired at 79,700, we sold them at 161,600. So the difference between the two will give us the gross profit, 161,600. We minus that answer, we get 81,900. The gross profit. Huh? Once you have your gross profit, the next step you need to ask yourself, does this business have other sources of revenue? Does it have discount received? Does it have commission received? Interest received? All those rent received. If they are there, or if we have any, it should first be added to gross profit before we proceed. Gross profit is revenue from sale of goods. After deducting the cost from sales, what we get now. If we have got additional sources of revenues, we add them there. So the revenues, when you are given a trial balance with the debit and credit, revenues are always credited. Revenues are always credited. So if you look at those figures on the credit side, we have any figure that is revenue related. From the top, 23,800 is for payables, no. The other one, 8,000 is for accumulated depreciation for buildings, no. Accumulated depreciation for equipment, it is not a revenue. Retained earnings, no. General reserve, no. Ordinary share capital, no. Debenture, no. Sales, no. So we don't have. We don't have. So we shall come here and say less expenses. Expense number 1. Let us deal with this that we have here. Debenture interest. For debenture interest, you take the whole amount that was payable, 1,200, the whole amount. We normally consider the whole expense for that whole year. It was 1,200. Then we had business rates. The business rates, they were amounting to 1,700. Office expenses. We had them as 925. Depreciation. First one is for land and buildings. Land and buildings, 4,000. Depreciation for equipment, 4,800, like that. Those are the ones that we have done an adjustment there. So we shall go back to our trial balance and identify if we have got more expenses that did not require any form of adjustment. So let us learn from the top so that we don't omit anything. Bank balance is not an expense. Trade receivables, no. Trade payables, no. Inventory, no. Land and buildings and equipment, we have considered their depreciation. Retained earnings is not an expense. General reserve, it is not an expense. Ordinary shares, no. 10% debenture, no. Purchases, sales, no. Carriage inwards, we have taken care of that. Carriage outwards is an expense. Carriage outward is an expense. So you come here and you capture carriage outward. It is an expense and it is amounting to 700. Debenture interest should come here. We have taken care of that here. Taken care of. Salaries. It is an expense. 38,500. Business rates, we have it here. Office expenses, we have it there. Sundry expenses is another business expense. How much? 200. Then we have directors' remuneration. I told you that one becomes an expense. Directors' remuneration together with the auditing fee, 11,900. We have captured all the expenses in that business. Can we do the summation now? $1,200 plus 1,700 plus 925 plus 4,000 plus 4,800 plus 700 plus 38,500 plus 200 plus 11,900. I'm getting 63,925. Okay, 63,925 as my total expenses. So I deduct from my gross profit, which is still my total income, 81,900 minus the answer, I get 17,975. We call that one now net or profit before tax. That is the figure we are referring as profit before tax. Profit before tax. What do we do from there? Now we are now at appropriation. Now switch your mind to the appropriation. Reaching at profit before tax, you pay the tax. You pay the tax first. Come here and tell me less corporation tax. Less corporation tax. And we are given in the additional information, the last one, number 6, tax charged for the year amounted to 10 million. 10 millions, but here we shall only use 10,000. We are, the 3 zeros are taken care of at the top there. So what do we get? After doing that, we shall get 7,975. After deducting that, we shall get 7,975. That is our profit after tax. Profit after tax. Then from there, add if there is retained earnings or revenue reserve in the trial balance. In the trial balance, do we have retained earnings or revenue reserve? It is there. It is there. It is there. The retained earnings is 13,600. 13,600 for the previous year. Retained earnings, note down 13,600. What do we get? If we add that, we get that one. Sorry, 79,75 plus 13, 21, 575. From that now, we pay the dividends, we transfer to general reserve, and then If there is anything that is going to remain, it is the retained earnings carried down. So we pay, we come here now from there, we less what will go to the dividends. In this question, we are not given about interim, final, preference, ordinary. We only had ordinary shares. We only had ordinary shares. So what we pay, it is only the ordinary dividends that we have computed there, that 500.
Mwalimu, question.
Yes.
In the general additional information number 5, they're saying that the directors have proposed that the ordinary shareholders be paid 5 per share after transferring 1 million to general reserves. Is that one captured, or we don't capture it at this point?
It is coming next. After we have paid the dividends, we shall write there, transfer to general reserve. Coming only that we are doing it in the order of priority. Okay.
Mwalimu,
Yes.
From what Winnie has just asked,
Yes.
won't we follow whatever the proposal was? Because my assumption will be, what if you pay shares and there is no amount to be transferred to the general reserves?
Okay, the priority here,
Mm-hmm.
it is first of all to give the shareholders some returns on the investment in form of dividends. You pay them dividends, and then if there is anything, then now, general reserve is like a saving. You are doing some form of saving so that the amount can accumulate for a certain particular project that the company wants to undertake. But the priority here is dividend first, and then we do the savings to the general reserve. Yes.
All right.
Yes. So the dividends we computed was 3,500. Okay. Then we have transfer to general reserve. We were told how much was to be transferred after transferring 1 million.
1,000.
Yes, so 1,000. Yeah. So we shall going to deduct 4,500. So if we had this, we have paid this, whatever we shall get there is the retained earnings.
Mwalimu, just move the screen so that we can see the bottom.
Okay, you can. Okay, let me adjust.
There.
Okay. Retained earnings carried down. 21,575 minus 4,500. It is 17,075. And that is the end of that statement. Okay. Are you done?
Mwalimu, I have a question.
Yes.
Is there any circumstance under which we can have expenses having a credit balance?
No.
Okay.
You know, expense it is you are paying.
Yes.
Yes.
Okay.
Mwalimu, if I understand correctly, so the retained earnings is actually like a, do we call it like a profit?
We call it actually.
Or it's like saving, or it's like capital. How do we?
It is known as, it is undistributed profit. It is a profit, yes, but it is after we have paid all this, we have paid the taxes, we have paid the dividends, we have transferred to general reserve, it is still hanging. It is not yet distributed. So it is a undistributed profit. So it is somewhere in the bank accounts of the company. It's in the bank
So it's like part of the capital.
Yes, actually, this carried down. we shall add it to capital in the statement of financial position that we shall be preparing shortly. That figure, 17,075, we add it to capital. That is now the retained earnings or the revenue reserve. Okay. Hope everybody is through with copying so that I can erase the board. So Kamoya Limited statement of financial position. So we all know the procedure. We need first of all to capture the non-current assets. We need a column for their cost. It is in shillings and in thousands. Accumulated depreciation, shillings in thousands. Net book value. The non-current asset we have here is land and buildings. Land and buildings, their cost was 80,000. Accumulated depreciation, we said you add the two for this year plus for the previous years. For the previous years will always be in the trial balance. So for land and buildings for the previous year was 8,000. This year, land and buildings depreciated by 4,000. So 8,000 plus 4,000, they have lost 12,000 cumulatively up to this date. This one will give us, this minus this will give us 8,000. That is the net value, the remaining value, that is equipment. First of all, cost, 32,000. Accumulated depreciation, for this year it is 4,800, but for the previous years, it is 9,600 plus 4,800, you get 14,400. So what is the net book value? That's 2,000 minus 14,400.
17,600.
Yes, 17,600. Those are the only non-current assets in that company. We don't have the other. So as usual, we only get the total for the net book value. These others, we don't need the year totals. You close them with the two lines like that. So 17,600 plus the net book value for land and building, 68,000. You will get 85,600. You will get 85,600. Come and capture the current assets. The current assets, we said, always find the value for the closing inventory. It is still an asset in the business because it is not yet sold. 31,700. 700. The closing, don't use the opening inventory. Then the accounts receivables, the trade receivables, which are the debtors. In this case, we shall use the figure as it is because we don't have allowance for doubtful debts. That to 100. What else do we have? Bank balance, it is a current asset, the first item. $800. Do we have any other really? We don't have any other current asset. So can we sum those? That 700 plus that 100 plus 800. We get 64,600. Add to the net book values. $150,200. That is total assets. Total assets in that company was $150,200. Then we come to the section where we
Mwalimu, that mathematics, it doesn't add up.
Doesn't add up.
Mm-mm.
Kuna kizungumkuti.
Oh.
Add up this one.
On my end, it's okay.
Oh, it's add up. Okay, sir.
Confirm. Kama kuna shida tuitatue mapema. If there is any problem, we solve.
Iko sawa mwalimu, iko sawa.
Okay. Equity and liabilities. Equity, we said, comprises the share capital. So we have the ordinary share capital. The shares that we sold, they generated 70,000. To this, we add what we have transferred to general reserve. This one, it is going to require some addition. Remember, there is general reserve in the trial balance of 12,000. So by the time the year was starting, already we have done a saving of 12,000 there. And then this year we have added 1,000. That is additional information number 6. So what we had in the previous years plus this one, so that reserve has grown to 13,000. To add the figure that is the trial balance plus what we have added this year. So remember, it is a reserve. Each year we are depositing something and it keeps on growing. So we should consider what we had already done there plus what we have added this year. Then we also have the retained earnings. Remember, this one we normally use the closing balance. Balance carried down. Don't use what is in the trial balance. Don't use what is in the trial balance, because what was in the trial balance, we added to the profit after tax. And then we got the new retained earnings. So we use the new retained earnings in the income statement. It was coming to 17,075 from the income statement.
Yes.
That is what we use. Don't use the one that we have in the trial balance. What else do we have here as an equity? This enough. So can we add those three? 70,000 plus 13,000 plus 17,075. It gives us 100,075. Then here we have long-term liability. And the long-term liability that we have, it is the 10% debenture. How much did we raise from it? Remember, that is a long-term loan. We raised 12,000. It is the only long-term liability. So put the figure there. Something. Some members are saying my camera is not clear.
On my end, it's clear.
Let me try to switch to. Okay. Let me try to change to black pen, maybe.
No. It was clear. There was just a short period that it went blurry and then it's back.
Okay. Thank you. Yeah. The debenture is the only long-term liability that we have in that question. Then the others are going to be current liabilities. The current liabilities in that business. One, we have the trade payables. These are the creditors. Not worry who they are. The trade payables, 23,800. What else do we have? The accruals. Any amount that we did not pay by the end of the year, accrued expenses. One, we had this. Let me take you here. The accrued expenses we have, it is this accrued debenture interest. We have the accrued bank rates and accrued office expenses. Those three figures have not been paid by the end of the year. So they are liabilities from our business. So we add 600 for accrued debenture interest, plus 200 for business rates, plus 25 for office expenses. So how much are the accruals?
825.
825. The other thing that you need to note, the final dividends payable and the tax payable, by the end of the year, that amount has not been paid. That amount has not been paid. Remember, they were just the director's proposals, but those proposals have not been effected. So those figures are still outstanding. They have not been paid, and therefore they are going to appear here as our current liabilities. The final dividends, if we have final and interim is already paid. The final, it is just a proposal, not yet paid. You consider there as a current liability. The tax payable, by that date, it is actually a proposal, not yet paid. It's a current liability. So here you will also include the dividends payable, the full amount that you calculated there, that 500, and the tax payable, which was 10,000. These figures are still outstanding. So if we add them, 23,800 plus 825 plus 3,500 plus 10,000, it gives us that 8,155. Then now we add the equity, long-term liability, and the current liabilities. How much we getting? The total equity and liabilities. Just in 150, 200. And the moment the figures are in agreement, the total equity and liabilities and the total assets, they are in agreement, then everything is okay. Everything is perfect. Everything is perfect.
So, Mwalimu, if your retained earnings carried down is wrong, then definitely your figures will not match, right?
Exactly.
But does it mean I will still get marks if I put in the entries there?
Yes, accounting is not about correct entries. Maybe you find that the figure that you brought here as retained earnings carried down was maybe 17,000. You messed somewhere. This one would be wrong, but here you have ticks. You have ticks. It is only here that you go wrong and here. You'll end up getting very good marks.
Okay.
Follow-up question.
Yes.
Do we get marks where we do the workings?
Sorry?
Can I get 1 or 2 marks? Can I get 1 or 2 marks from the workings, additional information workings?
So when you bring them here, when you bring them to the statements, that is where you get double ticks. Double ticks on when you're pressing them correctly and in the correct amount after doing the adjustment. So,
are we supposed to show the workings there on our paper?
you have 2 options. You have 2 options. You can do the workings somewhere else, and then you bring the adjusted figures here, or you can adjust them here. You can adjust them here. Like, for example, if we were talking about business rates as an expense, you can come in and do here. You can write there business rates. When you are capturing your expenses in the income statement, you put into bracket. From this end, we had 1,500, you add 200, and then you report there 1,700. It is allowed. In the income statement itself, it is allowed. Or you can do the working there, and then you bring the adjusted figure to the income statement direct.
Mwalimu, move to your right.
I hope that is my right.
Thank you.
Okay.
Okay, thank you.
So that is the company accounts. That is the company. You can see it's very much related to the sole trade and the partnership, especially the statement of financial position. Not much is changing. It is only the equity part, the capital of the company. It's not the same as the others, but it is only that part. We introduce the debenture interest and the debenture, very much related. So that is our first session of today. I want us to have a break of 20 minutes. We resume at 4 with the others.
So should we log out, or we just continue in this link?
You can stay. I can just mute here.
Mute, yeah, okay.
Mwalimu, a question before you go. There's something I was checking yesterday, the topics that you've already covered, and I saw somewhere inventory something. Is it inventory control or something? I can't remember doing that.
Are you in a new or old?
I'm in the new curriculum.
New curriculum bado tunaendelea.
Oh, okay. So that one has not been, it's because it's a topic up there. So I thought maybe we forgot it.
No. I know we have not done the inventory, the evaluation of inventory.
Yes, yeah.